Inflation at 9.1%. Housing prices through the roof. And let's not even talk about our daily cost of living. Things are getting super expensive. What's going on with the Federal Reserve? Are they losing their grip? Can they really control the economy and the inflation at this point? Hello everyone, and welcome back to another episode at NOVARISE. And you're right, today we're going to talk about the Federal Reserve and what's happening with the economy. What is it that they're doing or not doing that could be impacting the overall economy, and what can we expect from that? So to analyze that, we are going to dive into this blog post that was created by the beautiful NOVARISE team. We decided to create our own blog because we realized that every time you wanted to do some research or search through the news, there was a lot of drama involved and there was a lot of noise that was kind of like in your face. And one way or the other, it created a lot of anxiety. So what we decided to do is remove all that noise and create our own source of news. And this is actually available to everybody who wants to tune into our channel or to our website. All you gotta do is just to visit our website, NOVARISEinvest.com. You go into the resource section and then onto blog, and you will find tons and tons of articles created with a lot of love by the NOVARISE team. Now, back to the topic of the Fed, what is truly going on? So before we dive into what's happening, why is it that they can't get things done, let's first talk about the Fed in itself, because we have a lot of people that are tuning in from different backgrounds, and I want to bring everyone up to the same level before we can continue. So what exactly is the Fed? Well, you've heard about the Federal Reserve. Most of us call it the Fed. And the Fed, well, just think of it as the main controller for the U.S. banking, right? And the Fed decides how much money circulates. Essentially, they have the significant responsibility of setting policies that can increase or decrease billions of dollars overnight. And how do they do that? Well, these are their tools, right? So first off, they work with interest rate adjustments. I'm sure that at this point, this is not new to you. The Fed has been in the news quite often. And as soon as we hear the word Fed, all we think of, hey, what's going to happen to our interest rates, right? So the Fed's primary tool is adjusting interest rates. When they lower these rates, borrowing becomes cheaper and saving seems less appealing. This is exactly what happened during the pandemic. When the Fed decided to lower interest rates, a lot of people went out and refinanced their properties. A lot of people started buying houses because they had access to basically cheap money. If you come to think about it, you don't have to pay as much interest compared to the rates that we're getting today. And so everybody just went nuts. And they did that with the intention to propel the economy to move forward. A lot of people were in a lot of fear and they were afraid to spend money. So what they did is that they lowered the rates to incentivize spending money and also to make savings look less, appealing, less attractive, less interesting. Why would you want to put your money in a savings account in a bank that is giving you no return whatsoever, when you can actually get all that money and invest it and make more money in return, right? So once again, this encourages people and businesses to spend more. But when the Fed raises interest rates, the opposite happens, less spending and more saving. So in simple terms, having lower interest rates can boost the economy. So that's the first tool. The second tool they work with is buying and selling in the open market. What does that mean? Well, the Fed buys and sells treasury bonds. When they buy bonds, they essentially pour money into the economy, which can reduce interest rates. On the flip side, selling bonds pulls money out of the economy, leading to potential rate increases. So now we're starting to see that the Fed has a role beyond just simply adjusting interest rates. They also set rules for banks. The Fed decides how much money banks should keep on hand based on their deposit. In the economy, it is referred to the reserve ratio. So what does that mean? Okay, let's just put it in numbers, right? So let's say, for instance, that you walk into a bank and you hear about a 5% reserve rule on a $500 deposit. So that means that that bank needs to keep $25, that's 5% of $500, and they lend out the rest. So if they keep $25 in reserve, they get to lend out $475. And the Fed has the power to adjust that percentage. And the more they adjust it, the more you'll see how the lending landscape starts changing, right? And this is not a new one, but it's actually very trendy. The Fed has the power of words. In other words, they act like influencers, right? Every time you hear about the Fed or you see Jerome Powell going on to the news, anything that he could hint or not hint, something winds up happening in the economy. In fact, you can verify this yourself. Every time there's a Fed meeting, you will see a reaction in the stock market. Stocks either go up or they go down drastically, all within a few minutes after the Fed's meeting. And there you have it, they're influencers now. So now that we know these facts, let's put one and one together, right? Why is everyone worried about the US economy? Well, you know that feeling when you're trying to find the right balance, like adjusting the water in the shower so it's never too hot nor too cold? That's literally what the Fed is trying to do, right? When it comes to interest rates. If they raise them too much, we might end up with something called a hard landing. Think of it like accidentally dropping your phone on concrete. And if they get the balance just right, we get a soft landing where it feels like putting down your phone gently on a pillow, right?
I've always thought that the soft landing was a plausible outcome.
And so according to some insiders over at Forbes, a lot of people are keeping their fingers crossed, hoping that the US economy will take the gentle path, cooling off without any major bumps. That will be nice, right? But what are the latest expectations from the Fed? Well, the New York Fed estimates that there's a 56% chance that we could see a recession next year. And it's a bit of an improvement from the 66% probability announced in August. So that's good news, right? So what's the big issue? Is inflation really the major problem? Well, I mean, at this point, I think we all know that inflation means you get to buy less with your money, right? So let's say that a cup of coffee last year was costing $3 and now it's costing you $3.10, right? So that's inflation in action. But I don't really want to go into all the details about the numbers. What I really want to bring you down is to understanding how is inflation measured? Like, where does this data come from, right? How do you keep an eye on inflation? So here comes the CPI, which is short for the Consumer Price Index. And that's like thermometer for inflation. This index watches price changes in things we use daily, like food, rent, clothes, and even our Netflix subscription. And it gathers information from 23,000 businesses and 80,000 products to give us an idea of inflation. If CPI jumps 3% in a year, it means we've got a 3% inflation rate. The latest stats show that the U.S. inflation rate as of September 2023, it's sitting at 3.7%. What do you think? You think that's good, that's high, too low, don't care? Let me know down in the comments. But I want you to pay attention to that 3.7% and compare that to the following number, 9.1%. This was the inflation recorded back in June 2022. 9.1%, that's quite high. And compare that number to what we're getting as of September 2023, we're talking about a nice decrease of 3.7, but yet, according to the Fed, their target inflation rate is at 2%. So here's a nice graph that my team pulled together, 9.1%. You can see this was June last year, and look at how it nicely dropped all the way to 3.7. In fact, we actually had a decrease to 3%, and all of a sudden it just went up. Interesting, right? So what is the link between jobs and inflation? Well, it might sound weird, but they're like the opposite end of a scale. More jobs and stable paychecks mean more shopping, which most of us will think it's a good thing, right? But more shopping means companies produce more, but their costs go up, and that leads to higher prices and higher inflation. That's why some experts say that a tiny bit of unemployment can actually be a good thing for keeping inflation under control. That's kind of a dark joke, isn't it? Now, let's just continue and let's also look at the unemployment rate. So the US is now celebrating a low 3.8% unemployment rate, which is a huge drop from the 14.7% we saw during COVID times. And you guessed that right, the Fed has a saying in here too.
That we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses.
Now that we got all the data, let's now look into the reason as to why the Fed is not able to control inflation the way it would like. Well, first, you got that stubborn inflation, right? So while the Fed has been working its magic trying to bring down prices, they're still playing catch up to hit that 2% dream. And just to give you an idea, my team also pulled out information regarding a core personal consumption expenditure, the PCE price index. This index doesn't count food and energy prices because they're volatile and less predictable. And this PCE index is important because it is the Fed preferred inflation measure. And the issue is that even with volatile products out of the picture, in August 2023, the core PCE price index was still up by 3.9% from last year on an annual basis. And that it's one of the indicators suggesting that we're dealing with the so-called sticky inflation, meaning inflation that wants to stick around and doesn't want to go anywhere. And that translates to more work for the Fed, right? So that's one reason. The second reason why things are out of control in a way for the Fed is that we're still dealing with sky-high interest rates. 2023 was a wild year in terms of interest rates, and I'm sure you know that, because the central bank raised them not once, not twice, but 4 times. And that pushed the federal funds rate target to 5.5%, a level we haven't seen in 22 years. And that's not the greatest news for businesses or ourselves, because that means that everything is getting more expensive for us. Then there's the job market roller coaster. Generally, the U.S. job scene has been on a good ride, but there has been significant layoff trends since the beginning of 2022, especially in the technology sector. Now, I want to make a pause here about the layoffs in the technology sector because, again, the news, you have to take them with a grain of salt. All you hear in the headlines is, oh, this many people were laid off, this many people were laid off, but nobody bothered explaining, hey, was this really as bad as it looks? Yes, there were significant layoffs in the tech sector, but if you come to think about it, why? Why were there layoffs? Well, there was the pandemic, right? And there was an everything digital area. Everybody wanted to go online. Nobody wanted to get out of their houses. Everybody wanted to order things online. Everybody was hanging out a lot on social media and stuff like that. So that means that those tech companies needed to hire more people overall. And what happens after the pandemic? Things started going back to normal, and the digital boom was no longer a boom. Everything started normalizing, and the companies that ended up hiring all those people did not need them anymore. So they had to let them go in efforts to cut down costs because there was less demand. And when there's less demand, that means less revenue for them. But what the news failed to cover was that, yes, there was laid off, but the people that were laid off, they immediately found work afterwards. Because if you come to think about it, the skill set that they gained in that technology sector is actually very transferable. Think of Facebook, for example, or Meta, whichever you want to call it. Someone that worked in Facebook probably amassed a ton of knowledge regarding social media or anything that has to do with that platform. They can take that information and go to hospitality, go to restaurants or real estate, and work in their marketing platform as a way to help those companies increase their social media presence. So again, not all was lost. There was just simply a transition in a number of jobs that were let go on the tech sector and then eventually migrated to the other sectors in the economy. Now, back in the article, and once again, for those who actually want to read it and find out the data that I just mentioned, the information is right here. The interesting thing is that all these layoffs haven't influenced the low unemployment rate so far, meaning that people found new jobs fast enough. And here's a link for you to find the sources that are backing up our statements right here. So we've gotten to the point in where it will be fair to know what might happen next, right? But to answer this question, there are a few factors that we need to consider. First, the historical facts, right? Historically, achieving a soft landing for the economy has not been easy. When the Fed tried to control inflation before, it sometimes resulted in a recession. And this trend has been around since the 1950s. What's Powell's take on this? Well, according to the Fed chairman, to begin, a soft landing is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time. but given the past, it is quite a challenge. Another thing we have to consider is the famous twisted yield curve. In simpler terms, it's when the short-term interest rates go above long-term rates. And I want to make a pause here to illustrate what the whole yield curve means, right? So typically when you invest, the expectation is that you start up here, and the expectation is that over the years, your returns will continue to increase, regardless of the ups and downs in the economy, right? It would just simply continue to go up. But the reason why it's called a twisted yield curve is that the yield curve is no longer going like this. It's actually going the opposite way because now the returns are actually higher in the present than in the future. So historically, in the past, when a twisted yield curve happened, there was often a recession within the next 18 months. And that's exactly what happened in 2019. And you can actually see it here in this graph. The curve flipped, and shortly after, we faced the COVID-19 recession. It's kind of like a warning sign for the economy. And once again, here's a nice graph that you can actually take a look at yourself when you visit the blog. And this is how it looked in 2018.
Given the resilience of the economy recently, they are no longer forecasting a recession.
Now, hearing all of this, should you panic? Let's say what the team has to say in our blog. Still, before you start panicking, remember that it's not so bad after all. Right now, the US job scene is looking good, inflation is generally decreasing, and Wall Street says the Fed won't raise any interest rates again this year. What do you think? Do you agree with Wall Street? Let me know down in the comment section. Plus, if history has taught us anything, is that the American economy recovers after any type of crisis. So, what are the thoughts on our blog? Do you like what you saw? Did you like the information shared so far? Let me know down in the comments, and feel free to suggest any topics that might be of your interest that you would like us to cover in our blogs. I'll see you in the next video. Bye-bye.